US dollar to Japanese yen just painted a 1-hour sell signal while the whole world turns bullish. Citi just called 163 on a Topix breakout. That is a liquidity trap built for one thing: stop hunting. 2 scalp plays and 1 swing trade sit inside this mess. The invalidation is 161.79. If you're not watching that number, you're the prey. There is 1 danger zone and 1 hidden opportunity on US dollar to Japanese yen right now, and I'm going to show you both. The pair is sitting at 162.29, barely holding a level that the whole market is watching, while Citi just fired a fresh target of 163 on the screens. But the 1-hour chart just flipped into a strong sell signal, and that is exactly the kind of dissonance that crushes retail traders and fills institutional pockets. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade that you can execute today, with exact numbers, no guessing. If you don't know where the trapdoor is, you'll be the liquidity. I'm going to make sure you're on the other side of that trade. Write this number down. 161.79. If we get a daily close below 161.79 today, the entire short-term structure resets and the bullish grip we've been riding on the daily and weekly charts gets genuinely challenged. Right now my session bias is bullish, but I'm fading the intraday weakness, meaning I'm buying into the pullback, not chasing the breakout. The overall trend on the daily, weekly, and monthly remains a strong buy. The ADX is sitting at an absolutely monstrous 56.5, telling you this is a freight train, not a chop. Yet the 1-hour trend has flipped to a strong sell, and the herd is piling into shorts right at the 162.30 area, betting on a deeper correction. That herd is positioned exactly where the market loves to spring a trap. Institutions see that stop cluster below 162.17, and they know a quick run through that level will scoop up all those sell stops before the real move higher ignites. The CCI is hot at 111, the RSI still only 62, no overbought conditions, so the path of least resistance remains up, but only after the weak hands get shaken out. The pivot point for today's session is 162.44. We are trading just beneath it, which is a classic spot for a false breakdown before a reclamation. If we reclaim the pivot and hold above it, the next stop is 162.82, then the big 163.09 resistance. That is where the real fire will start. Let's walk the charts the way I see them, from the monthly canvas down to the 15-minute execution sheet. On the monthly, US dollar to Japanese yen has been carving a relentless series of higher highs and higher lows. The moving averages tell you everything. The MA50 is at 160.49, MA100 at 159.28, MA200 way down at 157.05. Price is trading well above all of them, a perfect bullish stacking. The monthly strong buy signal is not an opinion. It's a statistical reality backed by that widening US-Japan yield spread. On the weekly, the same picture. The uptrend has accelerated, and every dip over the last 2 months has been bought aggressively. The weekly MACD is positively charged, and the histogram bars are still rising, zero bearish divergence. Weekly S1 and S2 are way below us, so the weekly support floor is solid. Daily chart. Here's where the structure tightens. We closed yesterday right around 162.30, holding above the daily MA20 at 161.54, MA50 at 160.49, MA100 at 159.28. All Mars are sloping up. The daily MACD line is at 0.69, still positive, but I can see the histogram starting to flatten a touch, which means momentum is plateauing, not reversing, but enough that a 1-hour correction can feel violent. That's why the 1-hour sell signal looks scary to the untrained eye. It's a mechanical response to a small pullback within a raging trend. Now drop to the 4-hour. The 4-hour trend remains a strong buy. The 4-hour MA20 and MA60 are both trending higher, and price is currently floating just under the 4H MA20, around the 162.40 area. That's the bull flag hinge. If the 4H candle closes back above that MA20, the 1-hour noise vanishes. The 4H MACD has barely crossed bearish, but it's at an elevated level. This is often a fake signal before the real continuation. Here's what most traders miss. They see a 1-hour strong sell and hit the sell button, completely ignoring the fact that on the 15-minute chart we are printing a classic descending wedge with a series of higher volume lower wicks right on the 162.17 S1 floor. The market has tested that S1 3 times in the last few hours, and each time the wick slammed back up, leaving a tail. That tail is trapped short liquidity. The moment a fresh push below 162.17 triggers all those retail sell stops, the real buy orders, likely from option-related desks and carry trade flow, will absorb the liquidity and rip price back above the pivot. That is the trade. The measured move from that liquidity grab points to 163.09 and then 163.473 as the next magnet. And Citi's call aligns perfectly. They see 163 if Topix hits 4,500, which feeds the yen weakness narrative through equity inflows into Japan, which paradoxically weakens the yen via hedging flows. So the technical roadmap and the fundamental catalyst are converging. On the fundamental side, the last 24 hours gave us a clean driver. The core news is that Citi revised its US dollar to Japanese yen forecast to 163, explicitly linking it to a Topix stock index rise to 4,500. That tells you that institutional money is pricing in a continuation of the risk-on yen funding carry trade. The US 10-year yield is staying bid, the US-Japan rate differential is holding wide, and the Bank of Japan has given no concrete hint of immediate policy tightening. The intervention ghost always haunts this pair, but intervention typically comes when volatility spikes and the move becomes disorderly. Right now the move is grinding, orderly, and backed by yield differential, which makes unilateral intervention less likely. The market knows the Bojay's pain threshold is closer to 165, not 163. So the 1-2 week directional lean is bullish, targeting 163.50 and then 165, with the main risk being a sudden verbal intervention that causes a temporary 100 pip spike lower. The exact invalidation for this medium-term view is a daily close below the 50-day MA at 160.49. If that breaks, the carry trade unwinds and the structure flips. Do you think the dollar breaks 105 this week? Actually, the question for this pair is more. Do you think US dollar to Japanese yen clears 163 before the weekend? Comment yes or no right now. I'm tracking consensus and I'll pin the best argument. And now the section that most traders skip, which is exactly where the money is made. Keep watching, because I'm about to hand you 3 fully cooked trade plans, with exact entries, stops, and targets, built around the liquidity trap we just identified. I'll walk you through 2 scalping strategies for the intraday traders, and 1 session swing for those riding the daily trend. Strategy number 1, I'm calling the opening scalp. This is a high-probability snipe designed for the first clear signal after the liquidity hunt. Here's how it works. We wait for price to tap the 162.17 S1 level again, and on the 5-minute chart we demand a bullish engulfing candle that closes back above 162.25. That print tells you the stop run has been absorbed and the bounce is real. Entry is at the close of that engulfing candle, so around 162.25. Stop loss goes just beneath the session low that printed the trap. Place it at 162.12, a tight 13 pip risk. Take profit 1 is the pivot point at 162.44, giving you a clean 19 pip reward, about 1 to 1.5 risk reward. If the momentum is strong and we break the pivot with a volume surge, you can hold a runner towards the R1 at 162.82 for an extended target. The scalp is instantly voided if the 5-minute candle that follows your entry closes back below 162.15. That would show the sellers are still in control and you step aside. Simple, mechanical, no emotion. Strategy 2, the liquidity grab. This is a counternoise scalp for the fast finger traders who understand stop hunt mechanics. On the 15-minute chart, I want to see a fake breakdown below the 162.17 floor. Ideally a wick down to 161.95 or 161.90 that gets immediately bought. The trigger is a 15-minute close back above 162.10, confirming the snapback. Entry at 162.15 on that close, with a stop loss placed just beneath the wick at 161.85, giving a 30 pip stop that is still within the daily ATR of 70 pips. The target is a fast exit at the nearest intraday liquidity pool, which is the pivot at 162.44. That's a 29 pip scalp. If you want to be aggressive, you can split and take half off at S1 reclaim at 162.30 and let the rest run. But this is a quick grab. It requires fast execution and a finger on the trigger. The warning: if the 15-minute close after entry drops back below 162.00, get out immediately, because the fakeout might not be a fakeout. This is a scalping setup that exploits the panic of trap shorts. Now I'm going to ask you, are you scalping or swinging this week? Comment scalp or swing right now. I want to see where this community sits. Your comment helps the algorithm put the right traders into this room. Strategy number 3, the session swing. This is the trade that aligns with the 4-hour and daily strong buy trend, and it's built to capture a multi-session move toward 163 and beyond. The trigger condition is a 4-hour candle close above the 60-period moving average, which sits right around 162.40, and we also want the 4-hour MACD to print a bullish crossover to confirm momentum has shifted back in favor of the bulls. Entry on that close, so approximately 162.45. The stop loss is placed below the daily structural support, and that is the 161.79 level, your S2. I'll set the stop at 161.70 to give a little breathing room below S2, so a 75 pip stop. Conservative swing target 1 is the R2 resistance at 163.09, offering about 64 pips. The stretch target sits at a 3, 163.47, giving 102 pips. Risk reward on that first target is around 1 to 0.85. But if you take the second, it's about 1 to 1.35. Once price reaches halfway to the first target, around 162.75, move your stop to break even and then trail it using a 30 pip cushion behind the 4-hour swing lows. The medium-term outlook shifts only if we get a daily close below 161.50. That's your S3 area. A break of that level would indicate that the trend has been compromised and you would step away from any long swing exposure. This is a patience play. You're using the noise as opportunity and letting the yield differential carry the trade. Now, before we move on, I'm showing you the trade plan cards on screen right now. Read them, screenshot them. They are your blueprint. The opening scalp, entry, 162.25, 5M bullish engulfing after tap of 162.17, stop loss, 162.12 take profit 1. 162.44 take profit 2, 162.82 risk, reward, 1:1.5 or 1:4.4 are extended invalidation. 5M close below 162.15 voids the trade the liquidity GRAB entry, 162.15, 15M close above 162.10 after fake break to 161.95, stop loss, 161.85 take profit, 162 to 44 risk, reward, 1:1 are invalidation. 15M close below 162.00 invalidates the snapback entry. 162.45, 4H close above 60 MA with bullish MACD. Cross, stop loss, 161.70 take profit 1, 163.09 take profit 2, 163.47 risk, reward, 1:0.85 or 1:1.35 are invalidation. Daily close below 161.50 risk management pulse, and I'll be quick. Never risk more than 1 to 2% per trade. On these scalps, keep your risk extra tight because you're trading against intraday noise. No positions through high-impact news like US jobless claims or a sudden BOJ statement. Stops are non-negotiable. This is how you survive to trade the next big move. The market will always give you another opportunity, but only if you have capital. So let's pull it all together. The single most critical level for the next session is 162.17. That is the bull or bear line in the sand for the intraday structure. As long as that level holds on a closing basis, The trap is set and the upside towards 163 remains in play. If that level breaks, and we start closing below 161.79, the whole monthly trend will begin to show real cracks, and I will have a completely updated blueprint for you 24 hours from now. Tomorrow's wildcard is the Tokyo Open. We'll see whether the Asian session extends the 1-hour pullback or whether Japanese real money flow steps in and triggers the swing setup before London even wakes up. I'll be here with the levels that mattered if you want the full breakdown on trading commodities, Aussie, Yen, Euro, and Bitcoin. The videos are live now. Tap the end screen and you can loop straight into the gold analysis where I detailed the exact inflation yield trap. Then hit the bell so next Monday's alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that actually matter. I'll see you in the next one.